When you look at where we stand today, I think REITs are cheap versus broader equities. They do screen attractively versus private real estate. They look compelling versus where REITs have historically traded, and they look pretty fairly valued versus fixed income.
Hello and welcome to the REIT Report. I'm your host, Sarah Borgson-Keto. With me today to share her thoughts on where the REIT and commercial real estate market stands today and what investors should be paying attention to is Laurel Durkay, Head of Global Listed Real Assets at Morgan Stanley. Laurel, welcome to the podcast.
Thanks, Sarah. Happy to be here.
Broadly speaking, how do you think REITs and commercial real estate will perform in 2024 compared to last year? And what are the main macro factors that you'll be watching?
Yeah, so taking a step back a little bit, 23 was a really volatile year for REITs. At the end of October, REITs were actually down a little over 10% on the year, and yet we ended up 11%. I think that volatility was absolutely the result of interest rates, or rather the market's expectation of the direction of interest rates. We've seen time and time again that once interest rates stabilize after significant hikes, REITs do tend to outperform. What I've been telling people is that interest rate stabilization is a good thing for REITs. Interest rate cuts would likely be a great thing for REITs. And what we saw in November and December of last year is evidence of that. Now, despite that rally that we saw at the end of last year, I do remain constructive on the outlook for REIT total returns from where we are. When you look at where we stand today, I think REITs are cheap versus broader equities. They do screen attractively versus private real estate. They look compelling versus where REITs have historically traded, and they look pretty fairly valued versus fixed income. The macro backdrop is favorable with interest rate stabilization and the increasing likelihood of cuts this year. And I think valuations look attractive. On top of both of those things, fundamentals in certain sectors remain strong. So bottom line, I think if we assume no multiple expansion from where we are today, you could get an 8 to 9% IRR investing in REITs. Assuming some modest multiple expansion, which I do think is warranted, I think you could see an 11 to 12% IRR. So you asked, what is the main macro factor that I'm going to be watching? From that macro perspective, I'm laser focused on interest rates and inflation and jobs. There's going to be a circular relationship between inflation and rates. And so that's really important. And jobs are going to be a leading indicator to growth, consumer confidence, and spending, all of which are really important for the fundamentals of real estate.
Now, Laurel, with that as a backdrop, how would you describe investor sentiment toward commercial real estate? And are you seeing differences on a geographic basis?
So that one's tricky. I think investors are what I would call cautiously interested. But there does remain a lot of negative rhetoric out there on real estate and the potential for the other shoe to drop. It's most pronounced within the office sector in the US. And when I'm speaking to investors around the world, investors in Europe and Asia really do want to learn more about real estate, but it's hard to move past that conversation of the fate of offices in big US cities like New York and San Francisco.
What would you say are some of the key misperceptions or concerns currently circulating with respect to commercial real estate?
And that's my frustration. I think one of the biggest misperceptions is that buying REITs is buying offices. Getting the conversation past that point is where we as an industry really need to go. Office is less than 5% of my index here in the US. That number was about 25% 20 years ago. So obviously there's been a lot of changes. And if you look at where offices are in the private real estate market, it's almost half. So REITs are obviously very different. That is, I think, another misperception. REITs today are not your grandfather or your grandmother's real estate. There are some really powerful secular demand drivers that drive cash flow in some of these newer sectors. We have data centers, we have cell towers, we have logistics, we have healthcare. I think cash flow growth in just those sectors should range somewhere between 5 and 15% for 2024, which is different than the more traditional sectors within the broader real estate spectrum.
Now, Morgan Stanley recently highlighted the range of fundamentals within property sectors. Taking office as a prime example, how do investors sort through the noise to figure out what's really important as they make their investment decisions and look at other sectors to consider at the same time?
So there certainly is a range of fundamentals within different property sectors. Ultimately, it's about assessing value and identifying what's most important to these stocks. Here at Morgan Stanley, we have proprietary valuations to assess what properties are worth, and then we estimate cash flows and the future growth of those cash flows. Simplistically, real estate is really driven by the intersection of supply, demand, and credit. And so we assess these factors in conjunction with value, and that helps us make our investment decisions. Moving specifically to office as an example, broadly speaking, demand is lackluster, is a nice way to put it. Coming out of the COVID pandemic, we're still seeing the negative effects of hybrid work. Vacancies in a lot of key markets are very elevated. Utilization rates remain stubbornly below 2019 levels, and sublease space and availability is high. Now, you could argue things look a little bit better on the supply side in that we're not seeing a lot of new office buildings being built, and that's certainly a good thing, but it's not positive enough to offset that negative demand. And then you move on to credit. Financing and refinancing of office is really difficult today. Terms are just not good if you can even get a term sheet. And on the transaction side, very few are looking to deploy capital into offices. So debt financing is challenged and equity financing is very challenged. So when I take all of that into consideration, demand is bad, supply is good, but credit is bad. And then you turn it into valuations, I would say the backdrop is not overly compelling. Office companies are unlikely to grow earnings for several years. Rents are likely to continue to decline or flatline, and interest costs are increasing as debt matures.
Do investors need to be equally discerning when looking at property sectors that appear to be steaming ahead, such as data centers?
Absolutely. It's always about assessing fundamentals and then looking at valuations. And so when looking at the data centers versus offices, I would say they're basically polar opposites. For data centers, we have stronger demand than maybe we've ever seen. We do have new supply, but it's coming in below what we need. And that's because of power availability issues that is creating a lag in new supply deliveries. Turning to capital's free flowing into the space. Just over the last, 1 to 2 months, there have been announcements with committed capital or capital raised for data centers in excess of $70 billion. And I think that's just the tip of the iceberg. Then when you turn to valuations on a multiple basis, I think data centers look fairly valued versus history. But the growth rate is higher than history and has a potential to grow even more. So when we standardize that average multiple for the forward growth, I think the sector still screens attractively.
Where do you see the greatest potential for outperformance in the REIT sector this year? And conversely, what are you most concerned about?
There's going to be no surprise in my answer here. I would say I'm excited for those sectors that are displaying really strong and accelerating fundamental growth. So data centers that we just spoke about is a really good example of that. But another one is within seniors housing. So aging demographics are helping to propel demand in seniors housing. And I think that's going to happen for really the remainder of this decade. The 80 plus year old age cohort is expected to grow by about 4% through 2030. That's versus less than 2% over the past 10 or 12 years. This population growth should lead to outsized demand growth and outsized cash flow growth for those senior housing landlords. Another one, little less flashy or headline grabbing, is going to be companies that have the ability to really meaningfully reactivate their external growth pipelines. So given the dislocation in real estate pricing that we've seen over the past 18 months or so, it's plausible to believe there's going to be some distressed sellers that could come to the market. Companies that have been able to really maintain a reasonable cost of capital with a strong balance sheet, low leverage, limited debt maturities, I think they're going to be able to really reactivate internal growth in a meaningful way, and that would provide an upside surprise to earnings. I think it's going to probably be most meaningful for high quality companies within the net lease sector that have really underperformed over the past 18 months, given the interest rate environment, that are trading really cheap versus history. So those are the positives. On the negative side, I think it goes without saying, I'm pretty negative on prospects within office. But that doesn't mean that every company will underperform. I think there's going to be winners and losers, and it's all ultimately about the quality of the buildings and the quality of the management teams. Another interesting one that is causing some concern right now is actually within industrial. Logistics have been a huge winner, both fundamentally and total return-wise, for about 10 years. But this year in 24, we're seeing some really outsized supply that's going to be delivered. I think that's ultimately going to pressure rents modestly. But the problem is a lot of these stocks are priced for perfection, and the stocks could be range bound in the near term because of that. But what's exciting here is that the new supply delivery expectations are already forecasted to be down significantly by 2/3 in the latter half of this year and into 25. So with demand still strong and supply significantly waning, fundamentals 9 to 15 months out should resume the undeniable strength we've seen over the past decade. It's just over the more near term that I think there could be some potential weakness.
Laurel, are there any other themes or trends that you're paying attention to that we haven't touched upon already?
So there's two more things that I think are important right now. And that one is housing shortage and affordability, and then one is sustainability. So on the housing front, when you look today, home affordability is at multi-decade lows, and the potential for a higher for longer mortgage rate, or at least a higher than the past decade mortgage rate, coupled with the undersupply of single family homes, should serve as a long-term growth driver for single family rentals and the broader rental housing spectrum. Right now, traditional multifamily supply in the US is elevated, and that will be a governor on growth in the near term. But longer term, I think the outlook is pretty strong. So that's something that we're spending a lot of time on, assessing the fundamentals. And then finally, on sustainability and the impact sustainability measures will ultimately have on real estate values going forward, but also on the free cash flow of these companies. When I think about how retrofitting existing properties to meet new green standards, it's really going to require a significant amount of money, and that's going to ultimately eat into cash flows. Another thing from a sustainability perspective that we're really spending a lot of time on is just the assessment of physical risk, given the greater occurrence of extreme weather events. Ultimately, for me, sustainability is about assessing the financial materiality of these sustainability factors that will influence value and cash flows, and therefore the potential forward total returns. And I think it is growing in importance, and we really need to spend time on it, both as investors, but also as an industry.
Great, Laurel. Thanks so much for joining me today.
Sarah, thanks for having me. Appreciate it.
And to our listeners, if you enjoyed this episode of the REIT Report, please subscribe or leave a review on your favorite podcast platform.